Financial regulation addresses fundamental market failures, including information asymmetries between borrowers and lenders, and principal-agent problems between shareholders, managers, and creditors. It has evolved significantly following the 2008 crisis, with architectural reforms creating new authorities and expanding mandates. These reforms require sophisticated cost-benefit analysis and recognition that perfect stability would require prohibitive constraints on beneficial financial activities. Banking regulation has evolved through successive Basel Accords, each addressing shortcomings revealed by financial developments and crises. Basel I established the first international capital standards with simple risk weights. Basel II introduced more sophisticated risk measurement, though its implementation coincided with the 2007-08 crisis that overwhelmed its assumptions. Basel III subsequently strengthened capital requirements, including more buffers above minimum requirements and emphasizing higher quality capital, while Basel IV focuses on improving the benefit of internal models. Regulatory changes significantly influence bank business models and strategic choices beyond simple compliance effects. Lending impacts arise from higher capital requirements theoretically constraining lending capacity, while regulatory arbitrage results from banks restructuring activities to minimize capital requirements. Compliance economics show post-crisis regulatory expansion has substantially increased compliance costs, with large banks experiencing up to 10 to 15% operating cost increases. Deposit insurance systems protect depositors from losses due to bank failures, promoting financial stability by preventing bank runs, whilst ensuring small depositors are protected against loss. Different countries have varying coverage limits and funding mechanisms, with the UK covering deposits up to £85,000 per person per institution. These systems incentivize banks to manage risk appropriately, though they can also encourage riskier behavior by protected institutions. Post-crisis reforms have created comprehensive bank resolution frameworks aimed at resolving failing banks without taxpayer bailouts while maintaining critical functions. Early intervention occurs when banks show initial weakness but remain solvent, while resolution planning prepares for recovery and resolution plans. Resolution execution implements resolution tools when banks reach non-viability, ensuring management of resolved entities and market confidence restoration. Financial stability has emerged as a distinct policy objective alongside traditional price stability and macro-prudential regulation. Stress testing involves supervisors testing bank resilience against severe but plausible scenarios, while macro-prudential tools address system-wide risks. Systemic risk monitoring tracks various risk indicators, including credit to GDP gaps, asset price inflation, and interconnectedness, ensuring institutions like the Bank of England's Financial Policy Committee can have a holistic view of system-wide risks. Today's banking industry faces unprecedented transformation pressures from multiple directions. Digital technologies are fundamentally altering service delivery models and customer expectations, forcing traditional institutions to reinvent processes designed for paper-based, branch-centric eras. Simultaneously, demographic shifts are altering customer bases, with institutions reconsidering organizational approaches about their business models, competitive advantages, and societal roles. Digital transformation in banking represents a shift from simply offering online services. It involves reimagining the entire banking experience for a connected age. Mobile and online banking adoption has accelerated dramatically, with the pandemic serving as a catalyst that pushed even reluctant customers toward digital channels. This shift has profound implications for physical branch networks, cost efficiency, and customer engagement, requiring banks to persist post-crisis. Banks' responses to fintech competition span strategic options from competition to collaboration. Fintech firms have dramatically improved payment experiences through mobile wallets, peer-to-peer transfers, and frictionless checkout solutions that bypass traditional banking infrastructure. These innovations typically focus on user experience improvements rather than fundamental payment mechanisms, challenging banks to innovate and adapt. Open banking represents a paradigm shift from closed, proprietary banking systems to more collaborative, interconnected financial ecosystems. The UK's Open Banking Initiative and EU's PSD2 mandate standardized APIs for account access by authorized third parties, enabling customer data sharing and service competition. This regulatory foundation allows new service categories to emerge, impacting market dynamics and customer experiences. The banking sector's involvement in the green economy is growing through financed emissions rather than direct operations, making lending policies crucial to climate transition efforts. Banks face risks and opportunities as economies decarbonize, with potential for significant portfolio shifts and new market development. Green financing frameworks and net zero commitments are increasingly pivotal in aligning financial activities with sustainable practices. Corporate culture assessment has become a supervisory priority, with developing sophisticated approaches to evaluate ethical treatment of customers and market integrity. Post-crisis reforms have substantially allowed governance expectations for financial institutions, recognizing the risk management failures often stemmed from inadequate oversight and ineffective decision-making. Governance frameworks establish clear responsibility allocation across the three lines of defense. Banking market concentration remains high, raising policy debates on whether to limit the power of the top banking groups. This concentration partly reflects strong economies of scale, but also raises concerns about reduced competition and higher costs for consumers. Pricing power allows banks to maintain margins beyond cost considerations, impacting customer choices and market dynamics. SME access to finance significantly impacts broader economic development through their role in economic growth, innovation, and productivity. Financing challenges arise from information asymmetries, limited collateral, and higher transaction costs, which impede SME growth. Lending technologies and government interventions aim to address these constraints, supporting SME development and job creation. International finance has transformed banking by offering a complex global strategy with diverse regulatory and operational implications. Global banking models involve strategic approaches from multi-local to fully integrated global operations, while capital flows connect supplies and deficits globally. Regulatory coordination ensures consistent standards across jurisdictions, facilitating international financial operations. Global banking operations vary through various structural models, each reflecting different strategic priorities and regulatory considerations. Expansion strategies focus on organic growth versus acquisitions, while supervisory coordination addresses home-host relationships and information sharing. Regulatory navigation involves managing multiple supervisory regimes and requirements, ensuring compliance across jurisdictions. Exchange rate regime choice represents a fundamental policy decision with significant economic implications. Purchasing power parity suggests exchange rate movements should equalize the purchasing power of different currencies across countries, while interest rate parity connects interest rate differentials with expected returns. Central bank intervention and market microstructure influence short-term exchange rate movements, impacting trade and economic stability. Trade finance facilitates international commerce by addressing the trust deficit between buyers and sellers in different jurisdictions. Documentary credits provide payment security, while shipping and logistics ensure goods reach their destination. Settlement and financing offer working capital solutions, bridging payment timing gaps, supporting global trade and economic growth. International financial institutions play a crucial role in addressing different aspects of global economic and financial processes. The IMF promotes international monetary cooperation, while the World Bank focuses on poverty reduction and sustainable development. The Bank for International Settlements fosters cooperation among central banks, ensuring monetary and financial stability across member countries. Cross-border banking involves complex regulatory challenges, as institutions structure operations to optimize global strategies while managing risk. Capital allocation, liquidity management, and resolution planning require careful coordination between home and host supervisors. These practices include developing frameworks to manage system-wide risks while appearing compliant within individual regulatory environments, ensuring effective cross-border banking operations. Investment banking and asset management represent sophisticated financial services beyond traditional deposit-taking and lending. These activities connect capital markets with corporations and investors, facilitating capital raising, investment, risk management, and financial advice. Though often less visible to the general public than retail banking, these functions play crucial roles in economic growth, corporate development, and wealth preservation. The investment banking industry has undergone significant structural changes since the 2008 crisis, with regulatory reforms like the Volcker Rule and new fee structures forcing strategy reassessments and business model adjustments. Similarly, asset management continues to evolve with passive investing growth, fee compression, and increasing focus on sustainable investments. Investment banks serve as intermediaries between issuers and investors in capital markets, facilitating public offerings and private placements. They also provide advisory services for mergers and acquisitions, restructuring, and other strategic transactions. Sales and trading activities involve quoting buy and sell prices for securities, helping clients manage risk and liquidity. These functions provide essential support for capital markets, enabling companies to raise funds and investors to manage their portfolios. The asset management industry provides expertise and portfolio management services to institutional and retail clients. Various fund structures, like mutual funds, offer easy access to a wide range of asset classes. Passive equity funds track market indices, while active funds aim to outperform them. Fixed income and multi-asset funds offer diversification, while alternatives like hedge funds provide unique strategies. Money market funds offer liquidity with varying degrees of risk and return. Alternative investments have grown dramatically as institutional investors seek diversification beyond traditional stocks and bonds. Private equity involves investing directly in private companies, while hedge funds employ diverse strategies to achieve high returns. Real assets include physical assets like real estate and infrastructure, offering inflation protection and diversification. These investments provide opportunities for higher returns and risk management. Financial innovation continues to reshape the industry with developments like structured products, securitization, and passive investing. Structured products offer tailored investment solutions, while securitization has rebounded post-crisis, enabling risk management and capital raising. Passive investing has transformed fund management with low-cost, transparent options. These innovations create opportunities and challenges for regulators balancing innovation with consumer protection and stability. The financial services industry stands at a transformative inflection point, driven by converging technological, social, and regulatory forces. Technological disruption through artificial intelligence, distributed ledger technology, and advanced analytics is fundamentally altering competitive dynamics between incumbents and technology-focused challengers. Simultaneously, demographic and social changes are shaping customer expectations and market opportunities. Aging populations in developed economies create wealth transfer and retirement challenges, while emerging market growth drives financial inclusion and middle-class formation. Sustainability concerns increasingly influence investment decisions and strategies, with climate considerations becoming mainstream in financial markets. Central bank digital currencies, CBDCs, represent a potentially transformative development in monetary systems. These would provide digital versions of sovereign currencies, combining the trustworthiness and stability of central bank money with the efficiency and programmability of digital currencies. The Bank of England's exploration exemplifies both benefits and challenges. Meanwhile, private digital currencies and mobile payment ecosystems are expanding, offering new payment solutions and financial inclusion opportunities. The future monetary landscape will likely involve coexistence of multiple forms of money that share complete replacement of existing protocols. Artificial intelligence is transforming financial services across multiple dimensions, from customer-facing applications to core risk and compliance functions. The technology enables more precise credit assessments, identify non-traditional risk factors, and improve decision-making through feedback loops across operations. AI systems detect subtle anomalies and patterns in data, enhancing fraud detection and regulatory compliance. Explainable AI approaches attempt to address concerns about transparency, fairness, and accountability, ensuring AI systems in financial services are ethical and responsible. Banking business models are evolving from traditional vertically integrated approaches toward more flexible and interconnected structures. Platform banking represents a significant shift where institutions develop ecosystems connecting customers with a wide range of financial services, including third-party offerings. This model enhances customer relationship ownership and interaction control by embedding financial capabilities into non-financial contexts. Revenue models continue shifting from interest-based lending toward fee-based income streams, with data monetization opportunities increasing. The future financial landscape will likely feature blended models combining traditional banking structures with technology, regulatory compliance, risk management strategies, and sustainability initiatives. Environmental and social governance will increasingly integrate into mainstream financial decision-making, while hyper-personalization will enable unprecedented customization of financial services. Amidst these changes, the social purpose of finance remains constant, facilitating economic activity, enabling personal financial security, and allocating capital to its most productive uses. The successful institutions will be those that leverage technological and business model innovations to fulfill these functions, enhancing both economic efficiency and customer outcomes in an increasingly complex and dynamic environment.